Okay, so this particular lecture is focused on beyond the labor. Means now we know that labor is ended. So why labor ended? We will be understanding something about labor and some other reference rate which are going to replace the labors. Okay, some shortcomings of the labor, that why labor got reduced from the market, and then we'll reach out to the repo market. Okay, the chapter is going to very quick. Okay, because we have the good understanding of all the concepts which is written in this particular context, so it is going to be quick one, so keep your eyes open. Now the first point which they are starting with is the features of an ideal benchmark. Okay, the benchmark which fit in all the given parameters is considered to be as the best reference rate. Okay, so there are the three basic features. Number one, that is, it should be the rate should be derived from the actual data of the active liquid market instrument. Write down first point, it should come from actual data. Second, from the active market instrument. And when I'm using the word active, this means that that particular instrument should be liquid. Clear? Robust and accurate representation of the interest rate in the money market. So, another word, robust. Then, another word, accurate. And the another word is money market. That interest rate should be the good representative of the money market, that what's really happening in the money market, how much people are ready to pay, how much people are ready to accept. Clear? Now the rate which is coming from the money market can be utilized anywhere, even in the capital market. Okay, means the people outside the money market can use this reference rate as a base rate, and then accordingly use it to discount or compound their amount of money. Or if they want to find out the price of an instrument, fixed income instrument, they can do it. If they want to price an interest rate derivative like FRA, they can do that. So for that we need a reference rate. You remember, if we used to do FRA, forward rate agreement, what was our reference rate? We used to take reference rate as LIBOR. Clear? But there are many problems with the LIBOR, so we have to remove it. Clear? Apart from that, that reference rate should come for different maturity. It should not be like that it will provide only for 1 year. It should give you for 1 day rates, 6 month rates, 3 month rates, 12 month rates. Okay, 15 month rates, like this, 30 years rate. So for different maturity we should be having different rates, so that we can price all possible types of securities. Now the third point is the rate which is used as a reference rate, it will become the rate for the purpose of lending as well as for the purpose of funding. Means there are people who need the money, there are people who want to lend the money. Clear? So it keeps on changing. So it should be considered as a reference rate which can be used by anyone in the market. Okay, there are banks who manage their asset and liability, and they both work on the concepts of borrowing and lending. Apart from this, banks also enter into derivatives like swaps, so that they can hedge their long term and short term interest rates volatility. Clear? That comes with the combination of fixed rate as well as floating rate bonds. Clear? So this is the end of the first point, which is discussing about that which reference rate you will consider to be as the best reference rate which you can use. Okay, so what are those features which your reference rate should have? That it is coming from the actual data, it must be coming from the liquid assets, it must be robust, accurate, coming from the money market. Then that reference rate can be utilized in the capital market, can be used for the purpose of valuations of the fixed income product as well as interest rate derivatives like FRA. Clear? Also it gives you the interest rate for the different maturity. And the last but the most important one, that it can be used for the purpose of lending and funding benchmarks. Clear? There are banks, okay, who have the assets and liability, and they are totally based on the fact of lending and borrowing in the short run, then lending for the long run, and then they hedge themselves with the help of the swaps, with the help of the bonds, with the help of duration, with the help of floating rate bonds or the fixed rate bonds. Clear? Now let us move ahead to the second part, which is about that what are the issues with respect to the LIBOR rates. Okay, issues with respect to LIBOR rate, that why we have actually removed this LIBOR rates. Now, this is not the first time that we are shifting from LIBOR to SOFR. Okay, even before 1980s, before 1980, we were using US Treasury bill rate, US Treasury bill rates as the reference rate, and after that we started using LIBOR, and now we started using SOFR. Clear? So earlier also we have experienced that the reference rates keeps on changing based on the needs and the requirement because of the change in the market scenario over the period of time. Now, if you will see that US Treasury bills was basically the needs and the requirements of the US government. Okay, US government, but banks, okay, banks, they need a reference rate which can be most suitable for the bank when it comes to lending and borrowing, because they want to manage their basis risk which is created by the assets and liability. So there is always a mismatch in the basis risk in their balance sheet. So the LIBOR rate was created, the rate which is coming from the bank side, the rate which is coming from the bank side. So who decide the LIBOR rate? On a daily basis, multiple banks come into action, and then they decide that what should be the LIBOR for the day. Clear? So means it is the actual cost of borrowing and lending in terms of LIBOR rates. Means if there is a bank A in London and there is a bank B in London, at what rate he is ready to give and at what rate he is getting to take. Means Mr. A is giving cash to Mr. B. So at what rate, what interest rate Mr. B is ready to pay, and whether Mr. A is happy in that particular rate or not. So two banks are coming together to find out a rate in which the banks are comfortable. So like this, there are other banks C and D, they are also having the same kind of transaction. So at the end they will take the average and they come out with that this is the rate at which they are ready to lend or borrow. But this is a fictional lending and borrowing, they are not doing the real transaction. This is a fictional lending and borrowing. Suppose Mr. B say that he is ready to pay 7%. Mr. B said that he is ready to pay 7%, and Mr. A say, wow, I am very grateful to take 7%. The interest rate in the market is going 2%, but Mr. B quoted 7%. He can quote because he don't need to pay the interest rate in real terms. It's just a factual number. Okay, fiction kind of. So this is the reason, this is the major reason that we are removing the LIBOR now, because now the banks are quoting the rate of their own wish, because they are not doing the real transaction. Suppose if I'll give you an example, you'll understand. Mr. A, he needs to sell a laptop. Mr. A, he needs to sell a laptop whose cost is 50,000 rupees. Clear? Now Mr. B said that I am ready to buy your laptop at 80,000 rupees. So don't you think that Mr. A will deliver and Mr. deliver the laptop and Mr. B will deliver the cash of 80,000? Clear? But why Mr. B will pay 80,000? He is saying that don't worry, it's just a fictional number, I don't have to pay it, because Mr. A don't have to sell it, Mr. A don't have to buy it. Clear? But if they will do this transaction, then what will be the rate quoted in the market? The rate quoted in the market based on their transaction. So from tomorrow onwards, what will be the new price of the laptop? 80,000. So means two banks have the rights now that they can increase the interest rate in the market or they can decrease the interest rate in the market. So lots of manipulations are going on. So now multiple banks are entering into the bidding. Okay, suppose 15 banks enter into the bidding. Clear? So there will be 15 rates. Now there is an association, British Banker Association, BBA. They actually collect this data, and now they have 15 data. They will remove the top 4. Okay, and they will remove the bottom 4. Clear? Now when they will remove the 8 items from there, they have only the 7 interest rate numbers. Now they will take the average of it. Now they will take the average of it. Clear? But this is known to the bankers. They can even manipulate with that as well. Clear? So lots of manipulations is going on. Now the second problem is that during the period of 2007-9, okay, when there was a huge liquidity crisis, bank A is not ready to give money to bank B, because bank A is totally unaware about the credit quality of bank A, that how much asset do they really hold, amount of NPS. So means even at the lever, even at the respective lever, Mr. A, the bank of Mr. A is not ready to lend money to another bank, because lots of cash crunch was going on in the market. Clear? So if such a scenario, when no one is ready to give the money even at the LIBOR rate, then what is the use of the LIBOR rate? Clear? Now apart from the third point, which is based on the fact that the credit risk of the bank also got increased after the period of 2007 and 9 financial crisis. Clear? And when the credit risk will increase, the reference rate will be added with the spread means you cannot lend the money directly at LIBOR. You need to add the spread. Even the bank with the AAA rating, their credit rating have reduced during that point of time. Clear? And the fourth point is that when banks are not ready to lend the money at LIBORs, so they started using the repo rates. Okay, where bank A need to keep security with the bank B, and the next day the bank B will give back the security to Mr. A, and Mr. A will give the money back to the Mr. B. Clear? So that repo rate, okay, there was a cut in the money. That repo rate was mostly used in the market, and this will reduce the counterparty risk, because Mr. B have the securities of Mr. B A, and if Mr. A will default, B will sell the securities in the market. Clear? So the counterparty risk reduced, and it comes under the regulation. So it created a lots of trust in the market, that they started using the repo rates in the market. Clear? So the issues started from the manipulation. The second issue comes that interbank, they make the environment very difficult, that bank A is not ready to do the transaction with bank B. Clear? Apart from that, the credit risk of the bank got increased during that financial crisis, and LIBOR must be added with the spread even with those banks which are AAA rated. So people come up with the transaction which is based on the repo rates. Clear? Now a new association, okay, that come up with some of the ideas that how they will find a new rate, the replacement for the LIBOR. Okay, that is IOSCO, that is International Organization of Securities Commission. They come up with the recommendation that if they want some reference rate, first of all, that reference rate should give you the rates even for the overnight transaction. Okay, that have a large trading volumes, means today you need the money, tomorrow you will repay it back. The same will happen with the banks. Clear? So overnight transaction, the rates must be available for the overnight transaction. Clear? Apart from that, LIBOR was coming only from the banking institution. They are saying that this should not come only from the banking institution, this should come from the combination of money market, banks, insurance companies, investment funds. Everyone will participate, and when the sample size is large, then the chances of fraud will minimize, because if suppose they will do the fraud, they all will ensure that the average will come close to the real value. Now apart from that, what was the reason of the manipulation in Libor is that it was a fictitious transaction, but this reference rate should come from the real transaction. Means if Mr. B says that I am ready to give 8% interest rate, then they will say give 8%, give 8%. Getting my point? Now Mr. B will come to the track, say I'll quote 3% because I'm ready to pay only 3%. So they have to do the real transaction, and when there is a real transaction, this will ensure that everything is now coming upfront. Clear? Now there are many rates which are suggested. Number one is SOFR, which we are going to use, then Sonia, then Esther. These rates are from different countries. Okay, Saron and Tona coming from the Tokyo. Okay, TONA. Clear? Now let us also mention the countries. SOFR coming from USA, Sonia coming from United Kingdom. Clear? And then Easter, it is coming from the Europe. Okay, then we have Saron, it is coming from the Switzerland, and Tona coming from Tokyo. Clear? These are the countries. Now let us see those three parameters. First parameter is overnight. You remember? Overnight. Then wholesale. You remember all those, not only bank, money market instruments, investment funds, insurance companies, everyone will be participating in that. Apart from that, it is based on a secured transaction. I said na, there must be a transaction, so secured transaction must be available. Clear? Now all five checked, it has been found out that SOFR is giving the validation of each of the three. SOFR is giving the validation of each of the three. Sonia is giving the validation of these two. Esther is giving the validation of these two. Clear? Saron is also giving the validation of two, but only these two. And Tona is also giving the validation of these two. So means most of them are unable to give this secure transaction. Most of them are unable to give this secure transaction. Saron is able to give secure transaction, but they are unable to consider all the wholesale like insurance companies, pension funds, investment banking fund, market money. They fail only over here. So SOFR is considered to be as the premium one which consider all the three factors. Now coming to the last part of our discussion, that is the risk-free rates in the repo market. Okay, we are now going to discuss about the repo market, which is considered to be as the risk-free. Now why repo market is considered to be as the risk-free? Try to understand the scenario of the repo, then we will make the things easy. Mr. A need money and he hold the securities. Mr. B have lots of money. He is ready to lend. Clear? So he reached Mr. B and asked for the money. Clear? Mr. B gave the money. Clear? But Mr. A gave the liquid securities. Liquid securities like bonds. Okay, T-bills. Mr. A have T-bills. So Mr. A give the treasury bills to Mr. B and Mr. B gave the money to Mr. A. Say after 2 days, Mr. A is ready to pay the money back to Mr. B, and Mr. B will say, okay, I will give you your T-bills. Clear? So there is no counterparty risk. So that means it is considered to be as the risk-free rates. Clear? Apart from that, if Mr. A will default, Mr. B can sell those securities in the market, and he can recover his money. That's why the repo market are considered to be as the risk-free rates. Clear? Now the last point to be discussed over here is that there is a haircut on the security. Okay, haircut on the securities means if the value of the securities are say $10,000, then Mr. B will give say 9970. There is a haircut of $30. Clear? In the normal market scenario. But if there is a high risk in the market, okay, high credit risk, even there is a risk of those bonds that they can deviate a lot from the market, then the amount of haircut is higher. And now Mr. B is going to give say only $9910. So he'll be charging extra $60. Why? Because now the market is not safe. Clear? So there are two types of repo rates, one that comes with the secured repo rates as well as the one that comes with the unsecured repo rates. Clear? So the security, everything comes at the cost of security which Mr. A is delivering it to Mr. B. Clear? So topic is small, try to keep it quick and finish it, solve the questions, and then it's over. Okay, I'm ending this lecture here. Thank you.